Hi everyone, my name is Sonny Kovic and I am a realtor with Howard Hanna out of our Crocker Road office in Westlake, Ohio. And I wanted to just make a video today about talking about taxes and how where you live has an impact on certain taxes. So if you are a current homeowner, you probably have every idea of how this works. But if you are not a homeowner, you're planning on becoming a homeowner, well, you come to the right place. We're going to talk about how there are two particular taxes that will have, where you live will have an impact on how much you pay. So like I said, there are two taxes that you should be concerned about. Those two taxes are property taxes and they are income taxes. So again, we'll talk about both, but we'll talk about property taxes first, since property taxes are the ones that are the most expensive. So moving on, a little bit of background on property taxes. So property taxes are determined by the county, and they use a formula based on the appraised value of your house. So they take an appraised value of your house and they take 35% of that appraised value and they create what's called an assessed value. So they use that assessed number and multiply it by a certain millage, which we'll talk about a little bit later, and that gives you how much you're going to pay in property taxes. So that's basically generically how they come to the number that they come to. Most counties, I would say all counties in Ohio, are on a 6-year cycle when it comes to determining what you have to pay in property tax. So at the beginning of that 6-year cycle, you get a full-blown appraisal where the county drives by your house, they get a general condition of your house, they see if you've added anything and anything else that they use to determine the value. And that'll be appraisal number one. 3 years after that, the county will not do a drive-by, but they will do a comparable sales comparison to figure out what your property taxes would be. So for all intents and purposes, every 3 years, your home value is going to change. Now, you do have the ability to debate or contest your home's value. And well, why would you want to do that? Well, you could save some money, right? Some people will want to say, hey, my house is really valuable. They'd like that. Well, not when it comes to paying taxes. You want your value to be down, 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 down. So if you have the ability and you can, I've never actually done it before, but you have the ability to do that, to contest that. And so you would just contact your local county auditor's office and go through that process. So that's available for you. Those of you who live in Cuyahoga County, this is the year that they begin their full appraisal, the drive-by appraisal. So do with that what you may. And then I believe those of us here in Medina County, we get our home appraised, fully appraised next year. If you want, or if you don't know what your house's appraised value is, you can always go to the county auditor's office and look it up. So what do our property taxes specifically go towards? Well, we'll start at the local level, and your police, fire, and EMS. Those are the main public safety people. I would know that because I'm also a firefighter. So we appreciate you paying your taxes. But the police, fire, and EMS is one of your local needs. You also have your service department, your road crew, those men and women who are out making repairs on the roads and doing a lot of other things that you don't see behind the scenes. Your other local governmental offices, such as your building department, your mayor's office, your recreation department, all that stuff comes out of your property taxes. On a more larger level, you have your school district. There may be like a countywide JVS that is dependent on your property tax. Libraries. The Metro Park certainly is another organization that's dependent on your property tax. And there are various social welfare programs, among others, that count on our property taxes to survive. So how do you pay property taxes? Well, there's really two ways to do it. And those two ways are, one, you could pay the local governmental authority, the county, directly. So that's either the auditors, the treasurer, whatever the county has set up. You can pay them directly either via check or you just log onto their website. Some have credit cards that you just punch in information and there you go, your taxes are paid. However, most of us, because that previous method is good for people who don't have mortgage, but if you do have a mortgage, what you may end up doing is creating what's called an escrow account. And that escrow account is a special account that the bank creates. And as you make your monthly payments, money from your monthly payments goes into your escrow account, and it builds and builds and builds until one of the due dates are there, and then your bank automatically pays that for you. So those due dates come twice a year. They are billed in January and June, and they are due in February and July. So on the concept of buying or selling your house and how our property tax is handled here, well, this is kind of a very confusing topic. There's a lot of real estate agents, among other people, that don't really understand how this works. So I'm going to give you like the basic lowdown from each of the client's perspective, from the seller's perspective and the buyer's perspective, and how this works. So to make it easy, the seller basically credits the buyer at close for all the taxes that are due up to the point of close. So it seems simple enough until you understand that, oh, by the way, taxes in Ohio, when you pay your January of 2024 taxes, you are not paying up to that date. You're actually paying taxes that were due in January of 2023. So they're considered what we would say 1 year in arrears. Some people consider it 6 months in arrears, but either way, you're paying behind. So you can see how when you go to sell your house, how this can be an incredibly confusing concept to mesh these two things together, because for sure it's confusing. But to make it easy, as the seller, you're going to credit the buyer for the taxes that are due up until the due date, and the buyer will take that credit at close. So I want to talk about how you would calculate your property tax if that's what you wanted to do. Now, of course, if you already are a homeowner, this is very simple to do. You just go to the auditor's website and type in your address, and you should, see what it is that you owe. On top of the fact that you're getting a bill in the mail at some point to let you know what your taxes should be. So why this comes into play is because, let's say that one of two things happens. You see a house that you like in such and such a community, and you say to yourself, well, I wonder what the taxes are. Well, if that house is for sale, you should be able to just go to the listing on Realtor.com or HowardHanna.com or my website, SonnyKopic.com, and see what the tax is. That's the easy way. What makes it difficult is if you really don't have a specific house that you want, but you know the kind of area you want, and you know how much you can afford. So maybe we sat down and had a consultation, buyer's consultation, which I highly suggest you do. And we discussed through the work of a lender, we got you pre-approved, and now you know how much you can afford. So an example I have listed here, we're saying that the appraised value, or how much you could afford, is $200,000. So we're going to use that number to help you kind of figure out if you want. Now, I will tell you up front, there's a lot of people that really don't have too much of a care about how much they're going to pay in property taxes, simply because they know they got to pay property taxes. They're going to pay property taxes no matter where they live. So this can be somewhat more of an informational action than it is a decision-making action. But for many people, it is a decision-making action, and they want to know how much they're going to pay in tax. And if it's too much for whatever it is their budget is, they're not going to move there. So in this example here, I'm going to use the two communities that are near me. I live in Brunswick Hills, and obviously we're very closely entwined with Brunswick, so we're going to use these two communities to come up with our example. So in order to determine how much property tax you have to pay on a property, you have to know what the millage rate is. And what a mill is, it's considered $1 for every $1,000 in assessed value. Now remember, we have an appraised value and an assessed value. The appraised value is what the county thinks your house is worth, and the assessed value is 35% of that number. So if you have a house that's worth $100,000, the assessed value is $35,000, and it's that assessed value, that number, that they multiply a millage rate against to determine how much you pay in taxes. So in this example here, we show the millage rate for Brunswick and Brunswick Hills. Now, the other thing you got to kind of comb through a little bit on the millage rates is what the effective rate is versus the listed rate. The effective rate is what you actually pay. Now, there are automatic deductions that occur after your base millage rate. I have no idea where these deductions come from. I think it's from state law of some sort. You also get other standard deductions, one for being a homeowner. So if you buy a house and you live in a house, you get a deduction for that. You also get a deduction for being non-commercial. The non-homeowner deduction is important because if you're purchasing investment properties, you would not get that discount for that since you obviously don't live there. So anyhow, getting back to this number here, we have the millage rate for Brunswick at 87.35. And you can see right off the top that the millage rate for Brunswick Hills is 99.25. So without even doing any of the math, you clearly know that the property tax in Brunswick Hills is higher. So how much higher? All right, I'll show you how. So like I told you, the assessed value in the example that we're using, since you can afford only $200,000, well, I shouldn't say only, since you're using only $200,000, is 35% of it. So 35% of $200,000 is $70,000. So that's the assessed value. So we're going to take that assessed value and we have to see how many thousands are in that, because a mill is equal to $1 for every $1,000 in assessed value. So 70,000 divided by 1,000 gives us 70. And 70 times the mill rate there gives you $6,115 for a $200,000 house. So keep in mind that that is not what you would actually pay. There are deductions on top of that, but this is being done for comparison purposes. So let's bounce on over to the Brunswick Hills version. The Brunswick Hills version is the same formula. It's at different numbers. It's 99.285 mils. Again, 70,000 divided by 1,000, it's 70. Remember, 70,000 was the assessed value compared to the amount that you can afford, which is 35% of 200,000. So 70 times the millage rate, 99 point, I think I have 25 listed there, gets you $6,950 in tax. So generic math here says there's about a little over $800 difference between those two. So does that mean that living in Brunswick is cheaper than living in Brunswick Hills? Well, we'll talk about that a little bit later. We still have to figure out, in order to determine which one's cheaper and which one's better, is income tax. So there are all kinds of different income taxes out there, but we're going to specifically talk about municipal income taxes. You have state income taxes. There's even taxes on school districts that they can put on your income. I'm relatively certain that the Cloverleaf City School District has an income tax. So if you're thinking about living in a home that is in the Cloverleaf City School District, you would have to pay an additional income tax. And I think it's, offhand I forget, it's right around 1% or so that you would have to pay to the school district from your income. So those are municipal income taxes. So the way municipal income taxes work is that, for example, here, Brunswick's municipal income tax is 2%. So you may or you may not work in Brunswick. But if you work and live in Brunswick, this is what you pay. You don't pay 2% and then another 2%. It would be just 2%. In Brunswick Hills, and I'm relatively certain of this, most townships that I'm aware of cannot assess an income tax. So that's why Brunswick Hills' income tax is listed here as 0%. So let's give you a little bit of an example. Let's, for example, say that you make $50,000 a year and you work in Strongsville. Strongsville's income tax is 2%. So you're not getting out of that. Ain't no way. You got to pay your Strongsville income tax no matter what. And that goes for any community that you work in. You're not getting out of the income tax that the community you work in is charging you. However, some communities will give you a credit or some credit for the money that you pay for the city that you work in. So for example, Brunswick will give you 1% credit. Now, some cities don't do this, and some cities will cap how much credit they will give you. But in this case, Brunswick will credit you 1% for what you pay in Strongsville. So you don't have to pay 2%, you pay 1%. But you still, since Brunswick's income tax is 2%, they're only crediting you 1%, you still owe 1%. So 1% of $50,000 is $500, so you owe Brunswick $500. So let's go back to our example and try and figure this all out. So now we've got to put this together and figure out whether this means something to us. Okay, does this mean something to us? So a $200,000 home in Brunswick, let's review, was about $6,115 in property tax. We just talked about income tax. So income tax was $500 for a total of, that's right, $6,615. Your math is good. Let's move over to the Brunswick Hills version. The Brunswick Hills version, the property tax there was $6,950. Remember, there's no income tax, so it'd be zero. So your net there is $6,950, which is more than $6,615 in Brunswick. So is it cheaper to live in Brunswick? Well, not exactly. So why is that? Well, that's because the more you make, the more they take. So making more than $50,000 is obviously going to increase the amount of income tax that you have to pay to Brunswick in this case. The other complication to this occurs if you are married or you have other people living in your house. Those people also have to pay income tax. So if there's two of you paying, in the example before, if you both made $50,000, now you're paying $1,000 for the income taxes to Brunswick. Right. So here we are. We're at the end here. I appreciate you kind of sticking around and listening to this. I know it's a lot of information, but if you're confused, don't be. I have a consultation that I give my buyers where we talk about all of this. If there's stuff that you don't want to talk about, clearly we don't have to talk about that. But the consultation covers everything that you should know or need to know when it comes to buying a house, even on the seller side when you're looking to sell a house. My website's up there, sonnykovic.com. My phone number is up there as well. I'm on Facebook. You can message me there if you have any questions about anything. Just keep in mind that I am not an accountant. I'm not a tax professional. I don't work for the auditor. So specific tax questions you should forward to those professionals to give you the exact number and how they relate specifically to you in the event that I said something that may be a little bit off. So I'm just trying to give you a general overview to get you to understand how, where you live has an impact on what you pay in taxes. So I appreciate you watching, and we'll see you again. Thanks.